Hey you guys, welcome to our weekly Wednesday webcast. We're going to talk about how to build a startup financial model. So I'm going to focus on three key things today. Number one is what exactly is startup finance? Is it corporate finance or is it totally different? Number two, what is your growth equation? Every company has a growth equation, so I'll help you figure out what your growth equation is. And number three, I want to give you a real live example of two different companies focusing on the same exact problem, one for enterprise and one for consumer. I'm going to show you how they were vastly different and how actually in some ways they're actually the same. So let's go ahead and jump right in. So what is startup finance? So if you were to just Google right now, financial model, even startup financial model, you would end up with something that would conclude the traditional financial statements that we've been using for hundreds of years. So your income statement, your balance sheet, your statement of cash flow. So your income statement holds your revenue and your expenses. Your balance sheet holds your assets, your liabilities, your equity. Your statement of cash flow is really just an accounting document that just shows you what categories things went in, but not categories that make sense to a startup. So I believe in the framework that I created a few years ago called the Salient Six, which basically says there are 6 key components that you have to know to build a startup financial model. So number one is the most important, revenue. Number two is our cost of revenue. Number three is our R&D, research and development. And number four is our SG&A, sales, general, and administrative. And we usually break that S out and we usually add M. SM is sales and marketing. I like SAM, because I like acronyms. But you usually won't see that in a public document, but I personally like to use sales, advertising, and management, and marketing, that is, and then take administration out. So that gets you to your operating income or your operating loss. And then last but not least, number 6 is your cash from your balance sheet. So revenue, cost of revenue, R&D, SG&A, operating loss or operating income, and then your cash. If you have lots of inventory, I would add inventory to that list. But for most companies, if you're a technology SaaS company, you do not have lots of inventory. So if you just stick to those 6 key components, and 5 of those are from the income statement, 1 is from the balance sheet, 0 are from statement of cash flows, that will give you everything that you need. So just focus on the Salient 6. So that is basically what startup finance is. Now, if those are the number 6 categories that you need, what is 0? To me, the foundation is your growth equation. So Salient 6 gives you, number 1, your revenue. But how do you even get to number 1? You have to look at how consumers, how users, how customers are finding your product, your service, your platform, and how they're engaging. So your growth equation is very straightforward. It's how they find you. It's what is the magic moment? What's the secret sauce? What gets them really excited about your product or service and makes them want to keep coming back? And 3, repeat, retention. How do you get them to keep coming back over and over, not just for 6 months, not just for a year, but maybe for 5, 10, 15, even 20 years. So let me give you an example that everyone can understand, because everybody's on Facebook. Perhaps you were on Facebook before and now it's not cool anymore, so you're no longer on it. But at one point, everyone has had a Facebook account. I think 99% of the world has had one at one point. So in 2005, a friend said to me, hey, we're going to go to this event this weekend. Do you want to go? I said, yeah, great. Send me some information. He's like, well, it's on Facebook. Here's the link. So I have to create a Facebook profile. So I create the Facebook profile, and then what does Facebook do? Oh, hey, you might know this person. Oh, hey, you might know that person. Hey, why don't you load up your contact list from your Gmail account and then see who you know on Facebook. And then the list goes on. And who doesn't want to have 1,000 friends on Facebook? Everyone was like rushing to get as many friends as possible. So you want to connect with people that you know, interesting people that you want to follow. And before you know it, it's 2018 and Facebook is my digital newspaper. I will go to Facebook every single day, several times a day. I'm looking for current news, whether that's citywide news, national news, global news about what is going on in the world. I absolutely love Facebook as a communications platform. So what is Facebook's growth equation? Number 1, they got me in because they had something behind the curtain. It was an event that required me to create a profile if I wanted to participate. Number 2, what was the magic? What was the secret sauce? It was realizing how much they really have there, like how many different events and news feeds about different things that I care about and Facebook pages that I cared about were all in one place. And what keeps me coming back? That they constantly keep innovating. So Facebook has things like, hey, here's what you posted 3 years ago. They have Facebook Live, which everybody loves. They have Facebook Messenger. They have all these different things that they're constantly adding to the platform to keep you coming back. So that's the growth equation of Facebook. So think about that framework and think about how you can distill down what your company's growth equation is. So now that we understand that piece of it, let's go ahead and jump into that real life example that I want to focus on. So if you haven't been reading the news lately, on Facebook, of course, Dropbox just released their financials. So last year, they announced they were going to go public. They filed a confidential filing, which means they don't have to show their financials. And just this past week, they went ahead and they showed their financials. When I love finance, so of course, when any company releases their S1 is what it's called. It's the S1 filing that you file with the SEC, which is this, the Security Exchange Commission. Once I got that S1, I just wanted to dive into it and read it. And so here's the high level, I won't give you every single thing that was in there, high level detail that I think that you'd find really interesting. So first and foremost, I wanted to compare Dropbox to Box. So Dropbox is the consumer side. They are basically solving the problem that people have lots of files that they need to save and send around, but they don't want to store them on their hard drive. So they will store them basically in the cloud. So Dropbox is focusing on the consumer, you and I, and then Box, which is another competitor that went public a few years ago, they are focusing on enterprise, selling to corporations. So I'm going to talk about Dropbox, but I also want to talk a little bit about Box, their competitor. So with Dropbox and Box, they were both founded about the same time, about a year apart. But with Dropbox, they actually raised 3 times the amount that Box raised. But here's the interesting part. The 2 co-founders of Dropbox own 35% of the company at IPO, whereas the 2 co-founders of Box only own 6% of the company at IPO. So how is it, if you've been around for a while and you've been watching the weekly Wednesday webcast, that might seem kind of strange, but then the first thing you would think is, oh, valuation. Dropbox must have had a really high valuation so they were able to sustain all that amount. There's actually another reason why. That's one reason why, of course, but there's another reason why that we have not talked about yet on Weekly Wednesday webcast, so I'll tell you it now. Venture debt. So 1.1 billion of the money that Dropbox raised was venture debt. So it's just debt. It's not equity. So for example, when you're doing a convertible note, it's essentially debt, right? You're not diluting your company. You're not pricing the round. When you raise venture debt as a company, you're usually going in with a VC, a reputable investor, and it's just kind of, sweetening the deal, so to speak, for the company. It's non-dilutive. You simply just pay it back. The only one thing I would say is kind of a ding against Dropbox is they ended up having about 15 million in interest expense, whereas Box, the company that didn't take venture debt, only has about 1 million in interest expense. So that's one of the things that it's kind of an issue when you take venture debt, you actually have interest on it. But it allows you to hold a large part of your company. So that's one thing to think about as you're building your own company and you're going out to raise capital. So back to our comparison of their financials. So both started around the same time. Both raised about 500 million in VC because remember the 1.1 billion that was raised from Dropbox was actually venture debt. The interesting thing about these companies is if you start to look at the revenue, which is number 1 in our Salient Six, their revenue growth was about the same. So if you look at how they were growing, they were all growing about the same pace, even though the average revenue per user of Dropbox was twice the amount as the average revenue per user over in Box, which is really interesting to me. The next thing that was very interesting in their financials was that 90% of the consumers in Dropbox were self-serve. Basically, 90% of their revenue that came in, and they had about $1 billion in revenue, so we're talking about $900 million in 1 year, all came from self-serve. Now think about how beautiful that is. You build a SaaS product, you put it out there, it's so easy to understand, and the whole reason they want to come in, but that's the first part of your growth equation is why do they even want to join? Why do they initiate? If you've never been on Dropbox, I'm going to explain it really quick. So somebody sends me a file and says, hey, the file's on Dropbox. So I have to create a Dropbox account to go look at that file. So that's the first part, number 1 of their growth equation. So that piece of it is so well orchestrated that 90% of the people who just show up and become customers, paying customers, are finding it on their own. So $900 million per year because they made a product that is so easy to understand, and they're solving a problem and they're solving it in a way that made it go viral and took advantage of network effects, because the more people who add each other to the Dropbox, the more people have to actually create a Dropbox account. So that was a really interesting fact. So let's go back to their financials. So we looked at revenue, growth was about the same. Cost of revenue was very, very interesting. So cost of revenue for Dropbox was astronomical. It was huge. So looking at cost of revenue, what we found was that basically what they were doing is they were using Amazon Web Services, AWS, a third-party data center for their data. They actually switched that over and they created their own data center, and now their cost of goods sold is actually more in line. So that was one big piece of it. A smaller piece of it was they had a lot of inactive users on their account, people who would go ahead and create an account, load some files on there, and then never look at those files again. So after a 12-month period, they told them to take a hike. So basically they sent emails out and said, hey, you haven't logged in, you're going to lose your privileges. And after 12 months of trying to remind them to come back, if they didn't come back, then they lost their privileges, and then you no longer have to hold that data, which helps reduce your cost of goods sold, or cost of revenue, because there's actually no real good here. So that was a situation with their cost of revenue. So it was more of a fluke. I wouldn't say that's a standard thing that you would see, that a consumer-facing company would have more cost of revenue in hosting specifically versus an enterprise company. But that was a really interesting fact of that company. And then next we look at R&D. R&D was about the same. And remember that R&D is your research and development. It can be your engineering staff. And then next, S&M, sales and marketing. Now here's where it gets really interesting. So for sales and marketing, as a percentage of revenue, it was double for Box, and Box is the enterprise side, right? So why do you think it would be double for Box? The percentage of the sales and marketing as a percentage of revenue was double. So think about that for a second. Why do you think it would be twice as high for the enterprise company? Now, I told you a second ago that 90% of Dropbox's revenue comes from self-serve. People who show up and just either they get a file, somebody emailed to them, or they hear about it somewhere and they just create an account and they just, start using it. And once they get to a certain point, they have to actually upgrade their account and they start paying it for a paid account. That's the secret sauce right there. So if you think about it, the enterprise company has to have inside salespeople, outside salespeople, travel expense to go out and get these corporations to sign up. Whereas with Dropbox, the consumer side, 90% are self-serve. And that's why their sales and marketing as a percentage of revenue was substantially less, 50% less than that of Box, the enterprise company. So think about that as you're building a company, because the bottom line is Dropbox's net loss, that's their net income, was negative 10%, whereas Box was negative 30%. So which company would you want to be? It's never good to have a net loss, but I'd rather have a negative 10% net loss than a negative 30% net loss. So at the end of the day, as I look at these two companies together, Dropbox, the consumer side, and Box, the enterprise side, I see a few things here. That venture debt is really useful, especially in a later stage company. You're not going to do venture debt in an early stage company, but as you get growing as a company and you do a B round, a C round, a D round, think about venture debt. The second piece of it is looking at that growth equation and thinking about the experience that consumers are having on your site. How do you get people to be 90% self-serve? I mean, how do you build that kind of SaaS company? So think about how you're designing things, the problem that you're solving, how you're solving it. Are you solving it in a way that somebody would just come to your site or your app and just go, oh yeah, I know I need this. Boom, I'm going to sign up. And that's really the key of what you really want to do. And then you don't have so much in your sales and marketing expenses. So those are the really important things, is not diluting your company, holding on to a big chunk of it, getting self-serve. I wouldn't really say the whole cost of revenue piece where the hosting was a big takeaway, because that was kind of like an outlier. That was just kind of that specific company. As you get going, you probably are going to use a third-party data source, because data center, because you're not going to really build out your own infrastructure as you're just getting going. That's really for a company that's 7, 8, 9, 10 years old and has a lot of cash to actually do that. It's like a $50 to $100 million project. So as you're just getting going, please use a third-party data center. Do not try to build out your own. So just to recap, you guys, we talked about what startup finance is, and now you understand the Salient Six, and you also understand zero, which is our growth equation. And you now understand how to analyze companies using S1s. You can find SEC publicly traded companies all have SEC documents on there. You can find their S1s, which is the document that they file when they go public. You can find their quarterly reports, their 10Qs, their annual reports, their 10Ks. And you just kind of go through these and you start reading them, and you start highlighting what's important, and creating spreadsheets and figuring this data out. This is what I do in my spare time. I love finance. It's been my passion all my life. So if you have any questions about a company that you want to know more about, perhaps I've researched them, let me know and I'll answer that question. My email is super simple. It's just Lili, my first name, at financeforentrepreneurs.co. I answer all of my emails directly. So if you have any questions, please let me know. And if you want to go deeper into the growth equation or Salient Six, or if you want to go deeper into analyzing financial models and building financial models, which is so much fun, you can check out Founders Masterclass. That's a course I created. It's 30 days of content, and you can do it anytime you want, 24/7. You can do it in your pajamas. It comes with unlimited email support, so I will answer your question within 24 hours if it's course related. And if you want to get one-on-one help with me, you can join something called 30 Days of Mentoring. That happens January 15th, March 15th, June 15th, and September 15th. So only 4 times per year. So I will leave a link below if you want to see when we're launching the doors open. We usually open about maybe 10 or so days or 15 days before the actual event starts. And we do limit enrollment, so when it opens, you want to jump in right away. We have to cap it because it's literally me working one-on-one with people. I run a company called Atelier Advisors. I've been advising startups for the past 11 years now, and so I work one-on-one as an outsourced CFO, and I help them with their growth equation, with their financial model, with their investor pitch deck, with their investor contact list, and help kind of get them investor ready and get them in shape. So I do that one-on-one with companies, and so I can only take on so many clients at Atelier Advisors. So my Finance for Entrepreneurs world is me just giving out free advice to entrepreneurs. I do the Founders Masterclass in my spare time. 30 Days of Mentoring, I can only do it 4 times per year, and I can only have a limited amount of people in that class because I am doing it one-on-one. So I can't do my Atelier Advisors work and my Finance for Entrepreneurs work all at the same time if I'm doing way too many. So I want to really be able to focus on everybody who's in my 30 Days of Mentoring course. I want to be able to give you guys all lots of attention and time, so I can't do more than 10, 15, 20 companies at a time. So if you want to do it, I'll leave a link below that you can get on the wait list. You will find out when we open the doors. And we open the doors, try to get in as soon as possible because we do have to shut them once we get to a certain point. And I haven't figured out how many we're going to take for this coming cohort. Every cohort's a little bit different. Certain times of the year I'm like super busy, so I can't take on a lot. During the summer months, I'm not really busy with CFO work, so I can do more one-on-one mentoring with entrepreneurs, and that's really my passion, is to help you understand that finance is not hard. Like I said in the beginning, if you Google startup financial model, you're going to find all these really complex financial models. You do not need to know all that stuff. You have to know the Salient Six: revenue, cost of revenue, R&D, SG&A, operating income or operating loss, cash, and maybe some inventory. And you just have to figure out your growth equation, what really makes your company hum. And then once you understand that, pull out some benchmarks, go look at some companies. Hopefully, if you're doing something in data file storage, then perhaps you can use the examples I just gave you of Dropbox or Box. But whatever industry you're in, go pull the SEC files and research these companies. If you're looking at private companies, they're not going to have SEC filings, so you just have to go out there and do your homework. I did this for my first course I created was Lean Finance for Startups, and I reviewed Bonobos and Poshmark and all these different companies, and I analyzed them. I went through different interviews that they did, and at different points of the company's life, they gave hints at where they were at, right? They told how many users they had, they told how much gross revenue they had. I can go figure out what their commission was, and I just backed into all these numbers, and then by using like 10 different sources, I could map it out, and then like a puzzle, putting all these puzzle pieces together, I started to figure out what these companies' growth metrics were, what their revenue growth was, what their average revenue per user was, and all these different things. So you can do it. The information's out there. It just takes time. So if you want help with that, you can check it out, Founders Masterclass, or you can check out 30 Days of Mentoring. Or if you want to work with me one-on-one, you can ping me about working as a client at Atelier Advisors. I only take 4 clients per month at Atelier Advisors because, again, I'm working one-on-one with companies, so I have a limited bandwidth. I don't like to outsource my work. I like to do all of my work directly because I love financial modeling and it's so much fun. So we're going to wrap up today, you guys. If you have any questions, feel free to shoot me an email. My email, again, is just my first name, Lili, at financeforentrepreneurs.co, and I will respond back to you within 24 hours. All right, have a wonderful day. Take care. Bye-bye.